Okay, so investment appraisal, topic that comes up a lot on paper too, numerically or written form. This one would be a section A, so it wouldn't be as many marks, but it would be useful to just know the little techniques because it's the same irrespective of what you do with net present value and payback period. The first thing is you need net cash flow. So if you have a more involved question, which would be a higher mark than this one, you'd be breaking down each of the individual inflows and outflows and working out net cash flow. And there'll be a lot of marks attached to doing that. For this particular one, you've actually been told the profit. And you've got to factor in that investment appraisal is not based on profitability, it's based on cash flow. And so then what you've got to look at is, with the information you're given, what is non-cash or what is something that would affect cash flow differently than profit. So therefore we need to adjust that profit figure accordingly. And the only item that is the case for in this particular question is the investment. So we've got a £500,000 investment. So that would be a cash outflow in year 0, but from a profitability point of view, it wouldn't be. What we would do is we would spread it over its useful life of 5 years, whilst also accounting for the £50,000 residual value. So we would then use that to calculate depreciation, which will be the first mark in the question, really. So you'd go 500,000 minus the 50. So we've got to remember depreciation is an estimate as to how much of the value of an asset will be lost over its useful life. So we're not going to lose the whole 500. We're going to lose £450,000 worth of value is our estimate. We spread that over 5 years. That means our depreciation figure is £90,000. So that'll be your first mark is for calculating that. Then your next mark is for going, well, actually 90,000 is non-cash. So we've got to add that to profit because profit is deducting something that doesn't affect cash flow. So you would add that 90,000 to every year's cash flow. Year 0 would be minus 500,000. The year 1 through to year 5 will be 90,000 higher. And the other thing we've got to make sure we allow for is the residual value of 50,000 is how much we think we're going to raise in year 5. So we're going to add that to the cash flows in year 5. So extra mark for doing that. Once we've done that, we've got discount factors. So the idea that a pound now isn't going to be worth the same in a year or 5 years' time, depending on how long we're going into the future. And they're looking at a 12% cost of capital. Cost of capital, the cost of borrowing, or the normal return on investment that you would have. So for those new cash flow figures that you calculate, you're going to multiply them by each of those discount factors. And if you multiply this correctly, even based on your own figure, so if you didn't miss some of the steps earlier, you get a mark for showing you understand that that's what you're supposed to do. The second thing you're supposed to do is then add all of those up, making sure to deduct the initial investment, and you will have the net present value. And so therefore, you've got an extra mark for the net present value, you've got an extra mark for the discounted cash flow for each year. And so it's just really that methodical. If you're looking at a more extended one, like I've said, you're going to calculate each of the inflows, each of the outflows, marks for that, and then marks for calculating net cash for each year, then marks for multiplying by the discount factors, then adding them up. Don't overcomplicate investment appraisal. When it comes to payback period, what you've got to do then is work out how long it's going to take to recoup that initial investment. So in this instance, it's 500,000. And so the way we do that is we keep deducting. So we work out what we call cumulative cash flow. We keep deducting each year's cash flow from the original investment until we're not left with anything. And so if we look at year 1, so we've got 40,000 profits, that's 130,000 cash flow, so we're adding back that 90 like we said. And so we would just note in our question, so we're down to 370,000. Right, we've still got some more to pay. Next year is going to be 150. We start that, we've still got 220,000. So next year is 165,000. So we're going to take that off. We've still got 55,000 left. And so we keep on doing it. And so we've got 55,000 left. It won't be in year 4 exactly 55. I just realised how convenient that looks. But it's 145,000 left in year 4 because the cash flow is 145. So you would go 55,000 divided by 145. Then you can multiply that by 12 to give you the amount of months. You multiply by 365 for the days. And so then what you can then do is you can say the answer is 3 years. And yeah, it's 4.6 months. Or you can say 5 months, you can do whichever way you want to. And if you want to test your net present value, if you add up all those totals later, the net present value should have been 41,730. But yeah, investment appraisal comes up a lot. Make sure you can do it. Okay, good luck.